Hello, friends. Imagine logging into your bank account on a Tuesday morning and seeing a surprise $15,000 cash deposit from the United States Treasury. You didn't win the lottery, and you didn't sell your house. You simply used a hidden federal provision when filing your Social Security paperwork. Millions of seniors have been told to delay their Social Security benefits to make their monthly checks larger. But what the financial gurus forget to mention is that if you change your mind and suddenly need cash for a medical emergency, a new car, or a down payment, the Social Security Administration will actually allow you to hit the undo button. They will legally backdate your application up to 6 months and cut you a massive, one-time lump sum check for the money you missed. But if you don't know exactly how to ask for it, the agent on the phone will simply keep your money. I want to be perfectly clear right from the start. This is not a random stimulus check or a free government handout. This is the official, legal Social Security retroactive benefit provision designed exclusively for seniors who have already passed their full retirement age. By the end of this video, you will know the exact federal rule that allows you to backdate your Social Security claim for up to 6 months, the brutal 4% permanent reduction trade-off you must mathematically accept, and the one specific spousal benefit exception, where taking the lump sum costs you absolutely nothing in penalties. I am also going to reveal the spousal benefit loophole, a massive exception in the law where taking this retroactive lump sum actually costs you absolutely zero delayed retirement credits, making it the closest thing to free money in the entire Social Security Administration system. Stay with me until the very end to see exactly how that works. Now, rules change every year, and the government never reaches out to explain your options. Those who subscribe to this channel find out about these changes in time to make smart decisions, while others only find out after the money is gone for good. Hit that subscribe button right now so you never miss a dollar you are legally owed. Let's look at how this backdating rule actually works, because it all hinges on a single hard line in the sand known as your full retirement age. The Social Security Administration allows you to request up to 6 months of retroactive back pay as a lump sum, but you cannot use retroactive pay to backdate your claim to a single month before your exact full retirement age. If you are exactly at your full retirement age right now and you apply today, you get 0 months of retroactive pay. If you are 3 months past your full retirement age, you can only backdate by 3 months. To get the absolute maximum 6 months of cash, you must be at least 6 months past your full retirement age. To figure out where you stand, your very first action step is to determine your exact full retirement age based on your birth year. For example, if you were born in 1859, your full retirement age is exactly 66 years and 10 months. Next, count the exact number of months between that milestone and your current age today. If that number is 6 or greater, you are eligible for the maximum 6-month lump sum. If it is less than 6, you are only eligible for the exact number of months you have actually waited past your full retirement age. Let's look at John to see how this plays out for a real person. John was born in 1858, which means his full retirement age is 66 years and 8 months. In 26, John is 88 years old, meaning he is well past that 6-month buffer. His monthly check is currently calculated at $2,500. John applies for his benefits today and requests the 6-month retroactive payout. Because he knows the rule, the Social Security Administration deposits $2,500 multiplied by 6 months, resulting in a single $15,000 cash drop directly into his checking account. Then, his regular monthly checks of $2,500 begin arriving like clockwork the very next month. Keep in mind that this rule applies exclusively to retirement and survivor benefits. If you are dealing with Social Security disability insurance, the retroactive rules are completely different and can sometimes backdate up to 12 months based on the date of your disability onset, regardless of your age. But this massive $15,000 deposit is not entirely free. To get that lump sum, you have to surrender a portion of your future growth, and that brings us to the permanent reduction trade-off. When you delay your Social Security claim past your full retirement age, you earn what are called delayed retirement credits. These credits accumulate at a rate of 8% per year, which breaks down to 0.667% for every single month you wait. If you ask the Social Security Administration to backdate your claim by 6 months to hand you a lump sum, you are mathematically erasing those 6 months of delay. 6 months multiplied by 0.667% equals exactly 4%. You will permanently lose 4% of your monthly check's growth for the rest of your life. If you're considering this, here is your step-by-step action plan. First, calculate your projected monthly check if you were to apply today without any backdating. Next, subtract exactly 4% from that number. That new 4% lower figure is the permanent check you will receive for the rest of your life if you choose to take the lump sum. Your job is to decide if having a massive pile of liquid cash today is worth a slightly smaller monthly check tomorrow. Take Robert's situation as an example. Robert is 68 years old and has been delaying his claim. If he applies today without retroactive pay, his monthly check has grown to $2,600. But Robert needs cash now, so he chooses to take the 6-month lump sum, pocketing $15,000 in cash instantly. Because his official start date is legally moved 6 months backward, he loses that 4% of growth. His ongoing permanent monthly check drops from $2,600 to $2,496. Robert permanently accepts a $104 monthly reduction for the rest of his life in order to secure that $15,000 upfront. If your situation is different and you only need to backdate your claim for 3 months instead of 6, you will only lose 2% of your permanent growth. The reduction perfectly matches the exact number of months you request. How do you know if trading $104 a month for $15,000 in cash is a mathematically smart move? You have to calculate your personal break-even point. Choosing the retroactive lump sum is essentially a mathematical bet on your own longevity. You must divide the lump sum cash offer by the exact amount of monthly income you forfeit to see precisely how many years it will take for that upfront decision to backfire on you. To run this calculation yourself, follow these steps. Take your total lump sum offer, such as $15,000, then take the exact amount your monthly check will shrink by, which in Robert's case was $104. Divide $15,000 by $104 to find the total number of months it takes to break even. Finally, divide those months by 12 to find the exact number of years. Let's walk out the dollar math for Robert. $15,000 divided by $104 equals 144 months. When you divide 144 months by 12, you get exactly 12 years. That means Robert must live for 12 more years until he reaches age 80 just to break even on his choice. If Robert passes away at age 75, taking the lump sum up front was a brilliant mathematical move because he pocketed $15,000 that he otherwise would never have lived long enough to collect at a rate of roughly $100 a month. On the flip side, if Robert lives to be 95, looking back, it turns out to be a bad move because those missed monthly increments would have added up to far more over time. Now, your personal situation matters here. If a senior is sitting on high-interest credit card debt at 24% interest, taking a $15,000 lump sum to completely wipe out that debt right now is almost always mathematically superior to protecting a delayed retirement credit. The immediate relief from 24% interest completely dwarfs the long-term benefit of the extra monthly state credits. While the break-even math looks highly favorable for many people, you must watch out for a massive federal trap that can trigger if you receive that lump sum in the wrong month. The Internal Revenue Service calculates taxes on your Social Security using a formula called provisional income. If your provisional income crosses $25,000 as a single filer or $32,000 if you are married filing jointly, up to 50% of your Social Security benefits suddenly become subject to federal income tax. If your income crosses $34,000 as a single filer or $44,000 if you are married, up to 85% of your benefits become taxable. A sudden $15,000 lump sum deposit counts entirely as income in the single tax year you receive it, which can accidentally rocket you right over those cliffs into the highest tax bracket. To protect yourself from this tax spike, you need to follow this specific step-by-step action plan before you file. First, calculate your current estimated provisional income for the year by adding your adjusted gross income, any non-taxable interest, and exactly 50% of your projected Social Security benefits. Next, add the entire retroactive lump sum amount to that total. If that combined number pushes you over the $34,000 or $44,000 tax cliff, you should strongly consider delaying your application until January 1st of the following year. By waiting until January, the lump sum falls into a completely fresh tax year, allowing you to plan your other retirement accounts and investment withdrawals around it to stay under the limit. Let's look at Susan to see how devastating this can be if you get the timing wrong. Susan is a single filer with a fixed pension of $20,000. It is currently November. She decides to apply for her Social Security and requests a $15,000 retroactive lump sum. Because she receives that entire $15,000 in November, her total income for that specific calendar year spikes significantly. She crosses right over the $34,000 single tax cliff. As a direct result, the Internal Revenue Service legally taxes 85% of her Social Security benefits for that year, costing her thousands of dollars in unnecessary taxes. If Susan had simply waited 45 days and filed her application in January, that $15,000 payment would have counted toward a brand new tax year. That would give her the flexibility to lower her regular individual retirement account withdrawals to offset the lump sum, saving her thousands of dollars in the process. There is a variation to this situation. The Internal Revenue Service does offer a highly complex lump sum election tax rule using the specific worksheets found inside IRS Publication 915. This rule allows you to mathematically attribute your back pay to previous calendar years to lower your current tax hit, but the paperwork is notoriously difficult and you will almost certainly need to pay a certified public accountant to file it correctly. The Internal Revenue Service isn't the only government entity waiting to take a bite out of your lump sum. Medicare has its own silent clawback rule that surprises thousands of seniors every single year. If you use your retroactive backdating to establish your official Social Security start date, and that new start date automatically triggers your Medicare Part B enrollment backward into those same months, the federal government is legally required to collect your Part B premiums for that past half-year period. They do not mail you a bill for this money. Instead, they silently subtract the past due premiums directly from your lump sum before the cash ever touches your bank account. To avoid a surprise at your kitchen table, follow these steps. Check your current Medicare Part B status. If you are already enrolled and paying your Part B premiums directly out of pocket, or if you are covered via a Medicare savings program, your lump sum is safe from this specific deduction. But if your retroactive application triggers a brand new backdated enrollment, you must calculate the exact deduction ahead of time and expect your final bank deposit to be smaller than the raw math originally suggested. Let's look at David's case to see the exact numbers. David applies for a 6-month retroactive payout of $12,000. Because he wasn't enrolled in Part B yet, this application also initiates his Medicare Part B enrollment for those exact same 6 months in the past. The Part B premium is $202.90 per month. 6 months multiplied by $202.90 equals $1,217.40. The Social Security Administration silently subtracts that $1,217.40 from his $12,000 lump sum. David's actual bank deposit ends up being $10,782.60. Now, David didn't lose this money. It legally paid for 6 months of past health insurance coverage, but it can cause a massive financial shock if he had already signed a contract to use every penny of that $12,000 for a specific purchase. This back billing variation also applies to high-income earners who are subject to the Income-Related Monthly Adjustment Amount, or IRMA, surcharges. If your past income subjects you to a $400 a month IRMAA penalty, the Social Security Administration will deduct 6 full months of that massive penalty directly from your upfront cash before they release it. Knowing these rules is worthless if you don't know the exact mechanics of how to ask for the money, because the government will never volunteer to give it to you. You must explicitly demand it during the application process. If you file online and ignore the specific section where you can leave notes, your application will simply be processed for the current month, and those 6 months of back pay will be permanently forfeited. To execute this request perfectly, follow these precise steps. Go to ssa.gov and begin your online retirement application. When the system displays the prompt asking, "When do you want your benefits to start?" you must manually select the date that is exactly 6 months in the past. After navigating through the rest of the standard questions, look for the open text remarks section at the very end of the digital form. Type this sentence explicitly into the box. "I am requesting the maximum allowable retroactive benefits up to 6 months, as a lump sum payment. Let's look at Mary to see what happens when you don't know the layout of the form. Mary is 68 years old and decides to call the Social Security Administration to apply over the phone. The agent on the line walks through the script and asks Mary when she wants her benefits to start. Mary simply says, "Today." Because Mary said those words, the agent processes the application for the current month. Mary receives her standard monthly check of $2,000, but she legally left $12,000, 6 full months of back pay sitting in the government's vault because she didn't realize she had the legal right to dictate a start date in the past. If you choose the phone option like Mary did, here is a vital variation for your situation. Explicitly force the phone agent to read back the remarks section to you word for word before hanging up, ensuring they typed your exact request for the 6-month retroactive lump sum into the system. Now we have reached the payoff you have been waiting for, the Spousal Benefit Loophole. Remember that taking retroactive pay normally costs you 4% in surrendered delayed retirement credits. But here is the massive federal exception. Spousal benefits never earn delayed retirement credits. A spousal benefit maxes out at exactly 50% of the primary earner's benefit when you reach your full retirement age, and it stops growing completely. Therefore, if you are past your full retirement age and you are claiming a spousal benefit off your living husband or wife's work record, taking the 6-month retroactive lump sum costs you absolutely 0% in monthly penalties. To claim this consequence-free cash, follow these steps. First, determine if you are claiming benefits based purely off a spouse's work history rather than your own. Next, ensure you are at least 6 months past your exact full retirement age. Finally, file your application and explicitly demand the 6-month retroactive lump sum in the remarks section. You can watch safely as your ongoing monthly check stays at the exact same 50% maximum while you pocket the upfront cash. Look at Linda's situation. Linda is 67 years and 6 months old, and she is claiming a spousal benefit. Her maximum spousal benefit at her full retirement age of 67 was exactly $1,500. She mistakenly waited an extra 6 months to file, thinking her monthly check would grow larger. It didn't grow by a single penny. However, Linda knows the loophole. She files her application and demands the 6-month retroactive pay. The Social Security Administration hands her a lump sum check of $9,000, which is $1,500 multiplied by 6. Because spousal benefits don't earn delayed credits anyway, her ongoing monthly check remains perfectly locked at that maximum $1,500 level. She suffered a 0% penalty and secured $9,000 of pure consequence-free money. If she hadn't explicitly asked for that retroactive pay, those 6 months would have been erased and she would have permanently thrown $9,000 into the trash. As a critical situation variation, remember that this loophole does not apply to survivor benefits for widows or widowers. Survivor benefits do continue to grow past your full retirement age up to the deceased worker's maximum amount. This zero penalty loophole is strictly for spousal benefits, where the primary earner is still alive. Let's recap what we covered today so you can protect your wealth. We broke down how the 6-month retroactive boundary requires you to be past your full retirement age to backdate your claim. We looked at the permanent 4% reduction trade-off where you surrender lifetime monthly growth for upfront liquidity. We calculated the 12-year break-even lifespan formula to see if the gamble makes sense for your health. We uncovered the IRS provisional income tax bomb that can cause massive tax spikes if your timing is off, and the Medicare Part B back billing trap that silently clawed back over $1,200 from David's check. We walked through the exact text you must type into the online application remarks section to claim your money, and finally, we exposed the spousal benefit loophole that lets you claim thousands with a 0% penalty. Delaying your Social Security is a powerful strategy, but the 6-month retroactive rule acts as the ultimate emergency ripcord, allowing you to instantly trade a fraction of your future growth for a massive life-changing infusion of cash today. Subscribe. Share this with someone you know who's on Social Security or Medicare. I'll see you in the next one.